Good morning, everyone. My name is Ernie Humphrey, the Vice President of Educational Programs for Performative, the largest and fastest growing online resource for senior level corporate finance, treasury, and accounting professionals. First, I'd like to welcome everyone to the webinar, Leveraging Technology in the Financial Close and Disclosure Process. Accountants have been closing the books since the profession was formed. However, it is still a process that is often filled with stress and chaos. In today's close, there is inherent complexity and continued pressure for greater speed and accuracy as we strive for less time shuffling data and more time analyzing results and driving the business. Turns out there is a lot of new technology addressing the many issues hampering the close and disclosure process. This webinar will focus on reviewing current technology and techniques that can help your company close faster and more accurately and get to the disclosure, analysis, and reporting process in better shape with more insight. I'd like to thank our sponsor for today's webinar, Host Analytics, for making this event possible and free for us this morning, just like everything else we do on Performative. A quick note on today's agenda. First, we will hear a presentation from our featured speaker from Host Analytics, and then we'll move to our interactive Q&A session where we will spend the remainder of our hour. We would like this to be an interactive experience for you, so if you have any questions at any time, please go to the questions area in your GoToWebinar control panel and send us your questions. We can't promise to get all of them in, but we will do our best and we'll follow up afterwards on any questions we did not get to today. Before we get started, I'd like to address a few housekeeping issues related to the webinar today. A link to the presentation and video of this webinar will be posted and sent out to all attendees within 24 hours of the event. The slides are already posted out on www.performative.com and are for free for download. Those who would like CPE credits through NASBA, you'll need to answer the polling questions we're going to do during the webinar this morning. For any questions on CPE credits, please contact Tanya Walsh at twalsh@performative.com. We'll have another slide with Tanya's contact information at the end of the webinar today as well. Again, please ask questions on today's topic via the questions box in your GoToWebinar control at any time during the event, and we'll get to the questions during the Q&A panel discussion at the end of the event. Finally, you'll be asked to take a short survey right after the webinar is over. We greatly appreciate your feedback on today's event, as we always strive to improve the ROI we offer our event attendees for their valuable time. Quick word about Performative. We're the largest and fastest ongoing online resource for senior level corporate finance, treasury, and accounting professionals. We offer an unparalleled noise-free community of more than 600,000 CFOs, controllers, treasurers, related experts, and subject matter experts within which to share knowledge and get work done. Okay, let's get started with today's featured speaker, Brian dehmler-Buckley, Principal Product Manager, Host Analytics. Brian brings 13 years of experience in the corporate performance management software space to Host Analytics, serving in a number of different capacities. He's been an implementation consultant, subject matter expert for engineering, critical customer success manager, and product manager for Hyperion Solutions, Oracle, and Host Analytics. Prior to beginning his career in corporate performance management software, Brian led his accounting and finance background, working in public accounting and in finance for a global publisher. With that, I'd like to hand the floor over to Brian. Brian, please take it away.
Thank you, Ernie, for that introduction, and thank you, everybody, for joining today. To get started, we're going to talk about the change, what's driving the change in the close and disclose process. And what I want to start off with first is a discussion on kind of the current state of affairs and maybe some differences between what we have seen in the marketplace in terms of those companies that would be classified as bottom performers in their efficiency with which they are closing their books, and those which are considered world-class performers. Then we're going to jump into a quick discussion on some best practices that will allow you to move from the former to the latter. And then lastly, we'll wrap it up with a few empirical examples of customers that we've seen that have implemented technology to get them from that bottom performer state to the world-class performer state. So taking a look at our first slide here, you can see we've got basically two different categories, bottom performers and world-class performers. We realize this is a spectrum, but for purposes of this discussion, we're going to focus on moving from the low to the high here. And as you can see at first glance, the difference doesn't necessarily seem all that profound. 10 days 9-10 days, somewhere in that neighborhood, you may say, okay, that's not that significant of an improvement necessarily. But if you consider a company, and specifically the CFO and all of the folks that report to them, and you think that every single month it's 9 to 10 days, and every single month all the activities that that group is engaging in that the other company cannot engage in, really sets them up for having a competitive advantage in the marketplace. Now, what enables this? Certainly, there's a few factors that can allow you to move from one to the next, but technology these days is really the driving factor behind this, and it's made it a reality over the past few years. And what's important to understand, of course, is what companies do with this extra time. Okay, what do they do with this faster stream of data that technology is enabling? How do they utilize that to make better, faster decisions? And so we'll discuss a bit about that in our later slides, where we talk about the best practices associated with the close and disclose process and how companies are implementing those to become more effective. But before we understand all these outputs, let's take a look at how these close cycles are broken down in typical organizations and the best practices to get you to that next level of performance. So if we, based upon an analysis of our current customers as well as some industry benchmarks, we've come up with a categorization of the close cycle as it pertains to the bottom performers and the world-class performers. And as you can see for the bottom performers, a large amount of time is spent collecting and adjusting the data, right? Everybody's been party to this, where it's a huge aggregation effort to get this information from the resources across the organization. And that chews up, not only does it chew up personnel time, so there's lost efficiency for the individuals that are responsible for that, but it also chews up the ability to become more effective in terms of your decision making, because the individuals that need to participate in that process are bogged down with other activities. And as you can see, obviously, as you move up the chain, there's really a very little bit of time that's left at the end of the process to do any type of reporting and analysis on the closed data itself. And what's really driving this? In the past, systems just really haven't traditionally been designed to facilitate this type of process, right? They're the pulling data from the disparate data sources, the multiple GLs, global organizations that are constantly expanding and growing through acquisition, let's say, or even just organic growth, as well as the speed of business, right? With the information being shared so readily today, leveraging the internet, we have the speed of thought has increased, and therefore the need for faster and better decision making has also increased. And so we're kind of caught in this cycle of, we know we need to close faster, but we have these old shackles that have been placed upon us. We don't know how to break free of that. And fortunately, over the past several years, we've had technology that's been introduced that allows us to move towards that. And what we're seeing in our customers who have advanced to the world-class level is that it takes more than just a little luck, obviously, right? It has to be something else behind this. And really what enables world-class performers is really three things. Our CFO likes to talk about world-class performers really leveraging people, process, and technology. Okay, so having the right people with the optimal skill set in the right position puts you on that path to success. And then defining the most efficient processes based upon best practices and implementing those across the organization, as well as defining evangelists who can push your message throughout the organization, will again put you on that path to success. And lastly, utilizing the most effective technology, which is designed to leverage those people and support the processes that your organization has in place today, really seals the deal. Okay, and we're going to focus on that last one, because the people and the processes are things that that software can't solve necessarily, or technology can't solve, and they have to be part of the culture, part of your culture in the organization. And certainly the technology can help enable some of the processes, but at the end of the day, those have to be in place before the technology can really enable you to be successful. So as we discussed at the beginning, moving from bottom performing to world-class really frees up time. And now what is done with this extra time each month is what keeps these companies at world-class level. So the time is spent on projects which previously seemed out of reach. So projects such as operational analyses, comparative benchmarking, looking at yourself against your competition and what their metrics are compared to yours. Process efficiencies, how do we improve the close process? How do we improve the collection of data, the analysis of data, the whatever is hampering your organization, as well as getting involved in new projects such as XBRL, right? Taking that expertise and bringing that in-house if that's something that is germane to your business. Growth analysis, are we going to grow organically, or are we going to have an acquisition strategy? Do we make lease versus buy decisions? So all of these types of projects, which traditionally have been put on the back burner just because so much time has been spent closing the books, are now made a reality because you have that freed up time. Now, we need to recognize also this is not a level which you attain and then you're there. It's not like graduating and you get to that level, or you become a professor and you've obtained tenure. You need to keep improving to stay where you are. And to that end, we're going to talk a bit about the best practices associated with having a faster close and disclose cycle. So when I think of best practices, I think of a multi-layered process of best practices, some of which are going to apply and some which may not apply to your organization. But taken as a whole, they really provide a series of steps that you can implement to allow you to get to that next level of performance. And within this best practice framework, there are really two common themes that we see. And the first is best practices related to process controls. So controls that facilitate efficient processing of information or gathering of information or management of that information. So you can think of security controls or how users are provisioned to access information within a consolidation system. So without these controls, not only could you be out of compliance with certain accounting standards, which that of course is a no-no from an auditing perspective, but your workforce becomes less efficient if they're not optimally provisioned to do the activities that are pertinent to their job and or to their function. Now the second is best practices related to integrity controls. So making sure that information is accurate and traceable throughout the organization. So you can think about this in the context of accounting rules, which are enforced to meet standards, whether they be GAAP or IFRS or Basel II or whatever happen to be the standards that are in place in your organization or they are pertinent to your organization. Now let's consider in this example, minority interest entries, which are prepared based upon percentage ownership and control by the parent entity. There are certain standards that are specific to that in terms of what your level of ownership is as well as your level of control of that subsidiary. And having those baked into a system certainly makes you much more efficient so that you can actually focus on the analysis of that versus how do I make this up. In the following slides, I have assigned these individual best practices to one of these two themes, and sometimes the appropriate theme is going to depend upon where you're sitting within the organization. So from an administrative perspective versus an end user perspective, it might be viewed a bit differently, whether it's a process control or an integrity control. But at the end of the day, what's important is recognizing that those controls exist and how they need to be employed within your organization. So I'd like to start by visualizing a really simple example of a financial consolidation within an organization. So in this example, which we've just kind of viewed as a platform, if you will, here, we have 7 entities that are going to be consolidated. We have some manufacturing operations, we have a couple distribution facilities, a couple retail outlets, as well as some back office administration, as well as sales and marketing offices. Okay, so in our example, we have about 7 entities, and even with a limited group of entities, it's important to understand that in the consolidation, there still exists a risky combination of complexity and velocity that is needed to complete the financial consolidation. Now, complexity, I say, because there are a lot of rules that obviously need to be followed. Accounting is all about rules, and those are in place for a particular reason. And there's also risk that if they aren't followed correctly, what are the ramifications of doing that? So think Sarbanes-Oxley, FASB, IFRS standards, as well as XBRL, with all of the requirements today, and CFOs having to sign on the dotted line. That there's a lot more in play from a complexity and risk perspective that companies need to be aware of. Now, velocity, because there is always the need to compress the close process to get information out as quickly as possible. So along with that, there's a realization that an hour during the close process, or taking out an hour during the close process, is much more valuable than taking out an hour any other time during the month. So reporting the data out sooner and more accurately is paramount in this age of business at the speed of thought. As we talked about the risk that's associated with this process these days, you have to consider that the more time you have spent to analyze the information versus just collecting and accumulating that information, not only does it give you a level of comfort, of course, that what you're reporting out is accurate, but it also gives you an opportunity to make better decisions off of that data once you have that completed. Okay, so now we have this example that we're going to use as the basis for our discussion. And in this example, we're going to start around the concept of a close cycle by addressing the need for a corporate consolidation system. Now, what this means is a system that will not only facilitate the close cycle, so the nuts and bolts of financial statement preparation on a monthly, quarterly, or yearly basis, whatever it happens to be, but that it will interface with other areas of the organization, such as your budgeting and forecasting activities, your strategic analysis, and or your cash flow and treasury management. So if you think about legacy systems, they were very narrowly focused and really not optimally designed to support the close cycle and the need to integrate with these other activities across the organization. So the key challenge has always been that we can't just add data up and be done with the process, because we have additional adjustments that need to be made to that consolidated information. We have different accounting rules that are applied to that information before we can actually report that information externally. And in the past, that technology really hasn't supported that. A lot of those processes and a lot of those activities were very manual in nature. And so what you really need is a system that can do all of the above and more, such as aggregate, analyze, adjust, and report all in an iterative manner. Okay, and introducing technology allows for that iteration, allows for those multiple passes and the different variables to be applied to see actually how the performance of your organization is improving, or in the worst case, not improving, and how to adjust. So let's start off by talking about our first best practice, and that's establishing a book of record. And when I say book of record, I know there might be some confusion with a transactional book of record or financial book of record. And what we're talking about here is a book of record for your financial results. Okay, and this can and will be different than your transactional book of record, and that's perfectly fine. But you need to have a system which will be the basis for your financial results without having to do the gymnastics to get the data in a format for your external financial reporting or your internal financial reporting. And this is key so that there is no question as to where the data is originating from. Okay, data integrity obviously is the most important attribute of the closed cycle, and the need is great to have that data entered automatically and manipulated automatically, meaning that there's no manual intervention, there's no plopping it into Excel sheets and copying and pasting and other activities that might have happened in the past, but manually interfacing with those source systems directly into a consolidated system. And then once you have that data in, that you're manipulating those through controlled processes that can be defined and reviewed by the users of the system, by auditors that need to understand exactly how that data has been manipulated and by whom, and then ultimately that the data is reported in the required formats, again, internal or external. So if you have a management set of reports that might differ from how you report externally, or you have gap reporting versus your management reporting. And there's a lot of different formats that can be utilized, and having a system that enables that, because you have data in a single book of record, is going to be key to improving the speed with which you're able to get that information out. So building on the books of record, the next best practice is to establish a chain of ownership and make the consolidation process a collaborative one. So let's think about this in terms of driving accountability within the organization. So the more that you have people involved in the process, or the more people involved in the process, the more ownership there will be with the data that is aggregated and reported. So there's going to be less confusion around how the process is performed, and even less arguing about who owns the data. Okay, without this chain of ownership, answering the questions about consolidated numbers from multiple subsidiaries becomes more of a puzzle, and that's obviously not the efficient route that we want to go down. So in past lives and with our new customers, we typically see an attitude from some of the line level managers of, well, I've always just thrown the results over the fence, and corporate does their magic with it, and I really don't own it after that. Okay, so that could be a file from the general ledger that they extracted, or it could be an Excel file that they manage. But either way, it's important to establish that ownership to the numbers and the content, so you can always trace it back to the person responsible and have their support when you're analyzing the results. So, those aren't my numbers. It is such a common statement that we hear all the time, and the corporate process does not identify a chain of ownership, and I'm not involved in the process. Those are continual things that we hear from companies that are struggling with a very long close process in getting buy-in throughout their organization. So the key thing is to establish that there is a chain of ownership, and people have visibility into that, and that they have the understanding that the information that they put in the system is going to be their information that they're going to see, and they're going to report off of that. And if it's changed, they're going to be able to see who changed it and why. And those are important things that technology has brought to the table, so that people can not only see the chain, but they can also see the modifications to that. And we'll touch on that here in just a little bit as well. Now, to help manage the chain of ownership and the entire process, you need to have a method of managing the workflow. Okay, and we're not just talking about a corporate workflow of the close calendar necessarily, but the line level managers also need to manage their workflow, and corporate needs to have visibility into that. Meaning that there's a lot of processes that happen to support an entire close process, and those might be, like I said, a corporate close calendar. But when you drill down into it more granularly, there's a lot of other smaller calendars that are being managed at different levels throughout the organization. And so let's consider the examples of let's say line level managers that are doing things such as sending a general ledger file, and then also performing some top level adjustments, maybe some recurring journal entries such as vacation accruals every month, and then of course performing analysis to ensure that the data that they're presenting is the data that they would expect. Now, workflow attributes such as granular security control, which is driving process through user roles like a journal creator versus a journal approver versus a journal executor, not only support auditing requirements, but also improve the efficiency with which the users interact, because everybody understands their role, and the system helps guide them based upon that role so that they can perform the activities that they need to support their process. So in addition, there are workflow processes such as defined paths, which can be implemented for different user sets. So consider users who have a checklist of activities that they perform on a monthly basis related to the close. These actions should be built into a system that is repeatable, that allows them to expend energy on only those mission-critical tasks and reduce the noise of all the other tasks that might be out there. Okay, so they're much more efficient because they know what the expectations are, and they can proceed through those in a ordered manner if that's the way that you've decided to set that up, or they can process through those tasks as the information becomes available to them. Now, it's important over time for corporate to understand that these processes it's important over time for corporate to understand these processes and either incorporate them as best practices across the organization or work with the subsidiaries, line level managers to adhere to a more effective process if they don't seem to be working. So in the past, and similar to my previous comment, some subsidiaries saw the process as just throwing information over the fence, and they really don't have ownership or don't really think about it after that point because corporate's going to do their magic. Now, today companies should be moving away from that thought and should be thinking of more of a decentralized approach to financial consolidation where adjustments are made by those best in the know. So at a past client, I saw a company actually making an entry at corporate, and when asked about it, they had no idea why they were performing the entry. All the explanation they had was that it was a transaction years ago that a subsidiary told them to make, which is astounding because this thought of we have always done it this way has gone out the door. We can't operate in that fashion anymore. And so technology, through all of the capabilities of workflow and ownership, keeps all of that information in the forefront so that people understand why actually they're performing the activities and for what purpose in sharing that information across the organization. So inherently in workflow, you'll have tasks that allow you to apply rules to the consolidation process. So some rules could include intercompany elimination rules, minority interest rules, reclassifications, moving data from one bucket to another bucket within the accounting structure, currency rules, how do you handle foreign currency exchange? Are you in hyperinflationary currency? Or just journal entries where values are determined based upon real-time calculations. Okay, all of these rules need to be included into a system, and that's what technology is providing, is the ability to not only have kind of out-of-the-box rules. You know, we know a lot of these rules already. They don't change very frequently, but we also have the ability to support you know, ad hoc rules where customers can define things that are pertinent to their business that they want to certainly drive throughout the organization to make sure that everybody is performing the same activity. And the importance of these rules is that you can apply them repeatedly during the close process and have the comfort of knowing they are consistently applied. And the visibility is maintained for users of these rules, you know, what the logic is, what the detail is, to review should they need to understand in more detail. Because during the close, the books aren't just closed one time, obviously. It's a very iterative process. And it's the changes at the 11th hour that require people to scramble and readjust the data because values have changed. And if the rules are set in place, even those adjustments will respect the rules that are put in place. And if they need to be circumvented, then obviously there's a trail there where some action has to be taken, which can also be captured in the system. Okay, along with the application of rules, you also need a method of verifying the accuracy of the consolidation at every level throughout the consolidation or throughout the close. That is, users should be able to verify the accuracy of their information based upon rules like, is the balance sheet in balance? Okay, so as a subsidiary, I should not be consolidating up to a higher level if my balance sheet is not in balance. Same thing with fixed asset roll forward. Is that in balance? Does my beginning balance plus all of my acquisitions and dispositions throughout that period, do they equal the ending balance? If not, I should not be able to consolidate throughout the organization. Does my bad debt expense, is that the appropriate percentage of revenue that I had indicated as a corporate standard? So we've seen many of our customers have, in addition to this, have checklists of validation tests that they perform manually as each subsidiary submits their information. And when the corporate consolidation is complete, the only problem is that the 11th hour changes try to circumvent this process. So the great thing about having validations baked into a system allows you to, at any level within the consolidation, run these validation checks to determine if all of these rules are being respected. So as all of these processes are performed on the books of record, it is important to have an audit trail of all the changes. I mean, this seems pretty obvious, of course, but you'd be surprised out there how many systems, and Excel is a perfect example, doesn't really have an audit trail per se. So you can't necessarily track all of the changes that were made to a particular intersection of data from the beginning of, let's say, from the beginning of the close to the end of the close. That's really important information to know, and as you all are probably well aware, working with your auditors, that's something that they ask about all the time. So this goes beyond just the typical detail audit trail of tracking changes within the system, but it also includes interim reports that really help flag changes and reconcile changes in accounts. Okay, so a couple examples of that are proof reports. And these are reports which can really prove out certain processes, such as a cumulative translation adjustment, for example, or a retained earnings calculation. So these items are typically required by auditors, and as such they can provide a cost savings come audit time if they're already included in the system. Not to mention, users can spend a lot less time on accumulating this information and more time analyzing and determining what decisions to make based upon this. For example, in the CTA, that could lead to a hedging strategy based upon the mix of currencies that are currently being transacted in that helps you save money in the long term. But if they're spending all their time accumulating that versus analyzing it, you're probably never going to get to that decision point of what do I do with this information. Similarly, consolidating statements is another way that we can provide the audit trail of information throughout a close cycle. So we think about Accounting 101, of course, we used to have an account trial balance with rows down the side and columns across the top. It would include beginning balance, adjustments, eliminations, one-time entries, reclassifications, and then the ending balance. So this is a type of audit trail that you need to quickly assess the reasons for the change or the adjustment. And the ability to group and categorize this information in this manner allows for a much more efficient review of the buildup of a balance within the system. So, if having these reports readily built and not something you have to go construct certainly makes for a much more efficient review process and allows you to really do analysis by exception. So where you can pull out those items that are really of certain question that you need to take decisions on, or at least follow up with the individual who created that within your system. So the next key best practice after the books are consolidated is really reporting on that information, right? And this isn't this is really iterative as well. It's not just happens when things are complete, but it's happening throughout the process. And when you think about the accounting and the financial close process, there's a lot of work that's going on, and really the only visible value add other departments can see is through reporting. So the reporting must be automated and it must be flexible, meaning users should have the ability to twist and turn the data so that they can get to the particular point that they need to when they're doing their analysis. Now you also have to consider that financial reporting is a little bit different than operational reporting, because in financial reporting you really need to have control over every cell. You don't just add things up, you need to be able to look at it from a lot of different angles. And if you consider that, the example of a Rubik's Cube, looking at data intersections in most of today's systems is looking at it as if it were a cube. And so there's a lot of entry points to get to that same intersection of data. And without the visibility of looking at it from all those different intersections, you lose a lot of the value of that data and decisions that you could potentially be making off of that. Okay, so moving to the next one, and this is really an extension off of the last one, which is the automated reporting, is that we also have automated management reporting. So, automated reporting that we just discussed is really more about internal. So as we're building up the close process, having a system that allows you to do much more flexible reporting, and different types of reports could be ad hoc reporting, such as having the ability to look at data, a single data intersection or very small numbers of data intersections from a lot of different entry points, to more presentation style quality reports like traditional financial statements, preparation, income statement, balance sheet, and cash flow. that have certain needs in terms of the layout and format and what have you. And then you also have other types of reporting which will extend beyond that. So if you think about doing integrated disclosure reporting, for example, what this means is it's really about the accumulation of content that's needed for not only, it could be internal, but most likely external reporting. And we discussed the internal reporting in our previous best practice, but external reporting and reporting to boards of directors, audit committees, investors, and creditors are just as important, if not more. And accuracy of the data and confidence in the statements being prepared are the hallmarks of this reporting. So integrating this reporting with the system that is tasked with preparing that financial information, meaning where that, that book of record that we've been discussing, this ensures the accuracy and gives you peace of mind when presenting to these respective audiences. Now, beyond reporting is a best practice for creating management reporting. So this goes beyond just the tabular reports full of numbers, like a traditional financial statement, income statement, or balance sheet. But it also enhances or informs that data by providing textual and graphical interpretation to the financial information. So an example of a management type reporting is an SEC 10K or a 10Q that the public companies typically file in the United States. So they have the traditional numeric information, all the financial statements, but it's also full of narrative and footnotes, and it is best to automate this process and minimize the opportunity for error across the entire process from the ERP system to the management reporting SEC reports. So if you consider a system that can take the information, interface with your GL, pull that information in, perform the necessary adjustments and eliminations and entries that are required, consolidate all of that information up throughout the organization, and then prepare reports that are distributed out to your management teams, to your board of directors, or externally to a regulatory agency. That's a pretty powerful story if all of that information is being prepared off one single intersection of data. Okay, and that's the important thing about this, and really extending off of the external financial reporting, that integrated external financial reporting process with a closed system is a huge advantage to companies that are trying to ensure the control over their entire cycle to get to that world-class performer level. Okay, that having to spend less time interfacing with, let's say, a filer or a printer to do the XBRL processes, for example, in those companies are typically holding XBRL disclosure hostage at a lot of companies because of the turnaround time. These integrated solutions provide process which was basically typically facilitated by email and sharing of documents and bakes them into the product itself. So you reduce that manual intervention, you reduce that back and forth time because you have everything integrated within a single system. Okay, so the ownership at the end of the day is returned to those who wish to control their destiny by really driving that process throughout their organization and owning the results, both internal as well as external. So let's talk about in our example, or sorry, in our analysis, we have a few customers of Host Analytics that where we've had some success stories where they've utilized technology, and I said before, they typically have the people and the processes already in place to support this, but they've used technology to really obtain that competitive advantage. And a couple examples are, Groupon, which everybody's probably seen in the paper, is before they had implemented the technology, they had a pretty fast close in the grand scheme of things. They were doing it in 3 days, and that was roughly, at the time, it was about 50 companies across the world operating in 50 different currencies, and consolidating that in 3 days was pretty impressive given the fact that they were doing it mainly in Excel. So with the implementation of a technology system, a single system to actually do the consolidation, they brought that down to a single day. So you can see similar examples for the other companies where they basically reduced the time by 50% and 75% respectively. So technology itself is having a huge impact in the marketplace to bring down the amount of time that companies are taking to perform this complex consolidation process. Okay. So I wanted to touch on a couple other case studies just to make you aware of how other companies are experiencing the benefits of technology as well. So Laird Norton is a company that they had a few significant challenges, and that was basically that they had multiple charts of accounts across their subsidiaries, and that they were had a lot of minority interest relationships. And at the end of the day, they didn't really have a system that was going to give them the information that allowed them to report across the not only their internal departments but across the organization as a whole. So at the end of the day, they realized, we need to get onto a common chart of accounts, and we really need to automate the integration of the information from these disparate sets of accounts into this single chart of accounts. And at the end of the day, it's also about, once you have that automation, speeding up the distribution of that information. And so they realized also that having real-time reporting and online input of the financial data was going to allow them to get to that success level. And at the end of the day, too, this actual information doesn't just stop with the reporting. There's a lot of other downstream processes which are going to use this, and typical budgets and forecasts where you're doing budget versus actual comparisons and so forth is a certain benefit of that, of obtaining this information faster. So they implemented a technology solution with Host Analytics, and they achieved all of these items that they were looking for, and they achieved it in record time. And so they're another one of our success stories that has really improved their close cycle to allow themselves to do a lot of this more value-add work around analysis of data, as well as incorporation with other processes throughout the organization. So just to wrap up, wanted to just impress upon the fact that technology really is having a material impact on the improvements that are being made in the close and disclosure process. Excel, as we know, is not the tool to perform close and disclose activities. It doesn't have the key attributes of being able to consolidate information from across disparate systems and normalize that into a common chart of accounts. It's not collaborative in nature. It's really a desktop-based solution. And at the end of the day, it usually doesn't give you the kind of reporting that you're hoping to get out of the system. Additionally, cloud applications are purpose-built for those financial consolidations. If you think about solutions out there, Host Analytics being one of them, it was built specifically for doing these types of activities, and it was built specifically for operating on the cloud. So right there, you have two efficiencies that a lot of other systems out there do not have, because they were not architected in that fashion. And at the end of the day, by implementing these systems, you free up the time from the manual steps, whether it be collecting data or extracting data or munging data together to get it into a format that everybody can finally talk apples to apples. And you get to the value-added activities of doing the analyses on actually what your business is trying to do. And at the end of the day, what does that all mean? It means that technology becomes a competitive weapon for you. It allows you to have more time to analyze your competition, analyze what your strategies are going to be, so that you are making those you're making those decisions much faster, which puts pressure on your competition and allows you to continue to grow as a successful company. So with that, I will turn it back over to Ernie.
Thank you very much, Brian, for that outstanding and valuable content. At this point, we're going to go ahead and launch our polling questions. We would appreciate everyone's consideration in taking just a few seconds to answer our polling question. Again, please note, those of you in today's audience or after CP Credit today, you will need to answer both of our polling questions. I'm going to go ahead and launch our polling questions and leave those up for about 2 minutes apiece as we start our Q&A session, so we can take full advantage of the opportunity to tap into Brian's knowledge and insights. Again, as a reminder, if you have any questions you'd like to have us answered by Brian, please ask it via the questions area in your GoToWebinar control panel. Go ahead and get Brian our first question. Brian, what are your customers describing to you as the biggest challenge when implementing an integrated close and disclosure solution as opposed to what they're doing right now?
So that's a good question, Ernie. The biggest challenge that we're seeing right now is, well, there's really two, I would say. And the first is that the adoption within the organization. So the key understanding is that having a system that is going to automate, not only automate a lot of the processes that exist today, but also allow for better reporting is something that companies are a little bit resistant to. You know, with all the standards and the rules that are associated with the consolidation and close and disclose process, people are somewhat resistant to change. And so the first thing is just giving them a level of comfort and understanding that these applications have been purpose-built specifically for supporting these processes, and enabling them to see all the activities that they traditionally have been doing on a manual basis, and showing them how automated and how much time savings they will realize is really the key thing that we strive for throughout our prospect and customer base. And I would say that the second challenge that a lot of companies are seeing is the realizing how they can actually get the data out of the system and get out of the system more efficiently. And the biggest way that we approach that is we actually start with the outputs and say, okay, what are you ultimately trying to get out of the system? And when they typically share that information with us, it's readily apparent to us that that the solution will provide that. It's just a matter of getting the individuals comfortable with that.
Okay, great. Thanks, Brian. Next question is probably around a topic near and dear to a lot of people's hearts. On the regulatory front, especially with all the back and forth on IFRS, I saw an article the other day where they were actually saying they were going to make a decision within the next week. So what do you see as the biggest challenges facing some companies that you talk to comply with ever-changing regulations such as XBRL, IFRS, and even Sarbanes-Oxley as their business needs change as they go through mergers and acquisitions and go into new markets?
So probably the biggest challenges are, of course, just keeping up with the regulations. As you indicate, they're changing quite frequently, and as such, that certainly is a challenge. But I think the biggest challenge is to have a system that the companies actually own or majority own, so that they have that level of control to manage the business on their time frame versus somebody else's time frame. So if we consider XBRL just as a perfect example, traditionally we've had companies such as the printers and the filers that, and even some vendors like a Rivet or a Donnelly that are really controlling the process, and companies don't actually own that process, and as such they're being held hostage to the timelines that are being imposed upon them versus actually owning those timelines and being able to prepare the information on their schedule versus being held hostage to the turnaround times that these other companies are imposing upon them. So that certainly is a big challenge that we're seeing in the marketplace today. But I would also say that the complexity is probably as big of a challenge, and the complexity around all of the standards and keeping abreast of them. And so having a system that has a lot of the supports for those standards baked in already certainly can allow them to focus much more time on the value-added activities of analyzing the information versus just the actual accumulation and or categorization of the data.
Okay, great. Next question, is around, I think, more around the functionality part. Someone's pointing out that it seems like some of the ERP solutions accomplish, a lot of the best practices that you have today. How do you see the close and disclosure systems differentiating themselves from the traditional ERP systems and GL systems?
Sure, that's another good question too, and one we get quite frequently. So, ERP systems that have, in some form or fashion indicated that they can close and or consolidate information just like typical CPM systems can. And I would say the main differentiators are that typically, CPM solutions are built to allow you to consolidate multiple GLs, meaning if you have subsidiaries that have been obtained through acquisition and or just organic growth that have been allowed to make their own decisions on how they are capturing their data, certainly has caused rise to the CPM consolidation system where they can, we can take information from multiple data sources and consolidate that into a single chart of accounts and pull that into to the system and manage that accordingly. In addition, the purpose-built rules that I was talking about in the best practices, those have really been built into these close and disclose systems, not only for, like I said, kind of the nuts and bolts of the accounting around things like eliminations and minority interest and journal entries and reclassifications and allocations, but also around the reporting side of things. So establishing specific reports for supporting different standards, whether they be IFRS or GAAP or XBRL. At the end of the day, really, I think sets CPM solutions apart from the traditional ERPs that are more transactional based, focusing on subledgers and in a much lower level detail of transaction than what a CPM solution would be focusing on.
Great. Thanks, Brian. We got a question here around, how some of your how some of the folks that are making the investment in the technology define the value-added activities that a quicker close and process allows. So how do they quantify the benefits to look at the ROI on the investment to making this change?
Okay, yeah, that's a great question. So typically it's involved, or how they've started to quantify that is in people time as well as the actual additional activities that they are being allowed to engage in. So if you think about the additional time that's available, what a couple of our customers have done from an ROI perspective, and I believe we have a calculator internally that I might be able to share with the group, or maybe I'll share it on Proformative, Ernie, and we can, the participants can hopefully benefit from that. But they look at the efficiency of their workforce, and so a lot of companies have some pretty detailed tracking either through their CRM, or sorry, HCM or human capital management or even HR systems, what their individuals are performing on a pretty regular basis, and the additional activities that they're enabled to engage in because of the close process, they can then quantify that in terms of a dollar savings to the overall process, where in the past they might have spent, let's say, 70% of their time focusing on close activities, and now they're only spending 20% of their time focusing on close activities. They take that delta 50%, and that translates into a dollar ROI value. From other activities that they're able to engage in, meaning kind of downstream activities where, let's say, budgeting processes become much more efficient because data is available sooner rather than later. Those are typically quantified in either growth decisions, so ability to make decisions on, let's say, new investments, and the quickness with which they've been able to make those. Again, they've quantified that from the delta of, if I was operating in the traditional model, it would have taken me 3 months to do the analysis to ultimately make a decision, and now with the current model, it's taken us, let's say, 2 weeks, and so over that 2.5 month delta, what is the return on that investment that I made, and that factors into the ROI as well. So those are just a couple different strategies, and like I said, I can ask around internally for the calculator that we use and see if that's something we can share on Performative as well.
Oh, that would be great. Thanks, Brian. What I'm going to do now is I'm going to go ahead and share the results from our second polling question and ask Brian to comment. So the question was around what was the biggest challenge facing companies in the close and disclosure process, and I was a little bit surprised at the evenness there. So actually, people in process were actually higher than technology. So I just wanted you to first comment on what you're seeing from your customers, and also maybe speak to how the technology enables the marriage between the people, process, and technology.
So yeah, so I'm a little surprised as well that the people in the process are as bit high as possible. But you know, in the end of the day, at the end of the day, the people in the process are the ones that are really, I guess, have been around longer, and so there might be a little bit more legacy around the people in the processes, kind of holding the advancement up. And I guess I would say that you know, as far as comparing those to the technology, I would imagine if we'd asked this question probably 5-10 years ago, the gap would have been probably even wider at the time. That, you know, because the people who were doing the majority of the work and the processes were kind of what the processes had been in place and for a long time, and as such that there was, you know, kind of recognition that something needed to change, and that's where technology is really come into place and really starting to charge up the percentage here. And technology specifically enables people and process to come together and really understand what is happening in a given system or a given process or a given kind of a set of processes. And so specifically, we talk about the close and disclose systems that are out there. You know, it's bringing people that were fairly disparate and siloed in nature and bringing them together and incorporating the processes that they performed, again, in the siloed nature, and forcing them to come together and basically normalize and get to more efficient activities, because the technology, while it is always flexible, also provides some rigidity that will allow companies to benefit from better processes that need to be established to allow them to get to that next level.
Great, thanks, Brian. Got a few more questions here, then we'll close down the Q&A session for the webinar. Someone is asking, you know, we looked at a couple companies that had a significant, you know, a reduction from 20 to 10 days and 16 to 4 days. Can you speak to what was the main driver that allowed them to really collapse that close process that far?
So, so specifically, the couple of companies that we mentioned there, if you remember from the beginning of the presentation, where the good majority of the information or good majority of the time spent in an inefficient close is around the collecting and closing and adjusting of data that is part of the process, and that is really where the efficiencies have come in. So, if you use Groupon as an example, like I said, everything was Excel-based previously, and so the majority of their time was spent, because they had companies all across the world, was, you know, sending emails at you know, every time that something was due, and then following up with individuals when those spreadsheets weren't received, or reviewing those spreadsheets and seeing that there were some inconsistencies or incorrect data or reclassification of data that was required. And those kind of back and forth activities that really caused them a lot of wasted effort. And so once they automated the feeds from all of those disparate sources, then those individuals, you know, across the world, for example, could input their data at any time, and they didn't have to wait to send a spreadsheet and then wait 12 hours for that individual to wake up and then take that spreadsheet and then consolidate it in, and then if there was a question, wait another 12 hours. So the information is made available real time, and that certainly has sped up. Actually, the process for all three of those customers, it was primarily around just data gathering and analysis of data, which, as everybody's familiar with, Excel is fantastic in it in most respects, but if you're trying to aggregate large amounts of data from a lot of different sources and normalize that for analysis purposes, it can be a bit challenging, whereas if you have a system that has a common chart of accounts, it certainly makes it a lot easier.
Okay, thank you very much. Brian, with that, we're going to go ahead and close our Q&A session for the webinar today. I would like to thank Brian for his time and insights. If any of you would like to connect us directly with Brian, please indicate that on the survey you'll be invited to take immediately after the conclusion of the webinar. Brian is clearly a leader in his field and an excellent source of information on today's topics. Once again, we'd like to thank our sponsor, Host Analytics, whose commitment to thought leadership allows us to offer you this great educational content. Regarding CPE credits, again, in order to receive your CPE certificate, please send an email to Tanya Walsh at twalsh@performative.com if you didn't check the box on the way in to get your CPE credits. Again, there's going to be a survey. We appreciate everyone's time in doing that. In closing, I would like to thank the audience for your valuable time. And with that, we'd like to conclude the webinar this morning. Thank you very much, everybody, and have a great day.